We build portfolios around our investors' needs, taking in consideration return requirements and risk appetite. We consider the typical client a fund has been designed for and their key objectives, whether it's more important to grow or protect their capital, how long they are looking to invest for, and how sensitive they are for temporary dips in performance. Our aim is to maximize the number of scenarios under which our clients' objectives are met, whilst being mindful of the client journey. So this requires a balance between offense, capitalizing on opportunities to enhance returns, even though it might feel uncomfortable, and defense, avoiding any excessive one-way bets that could lead to permanent loss of capital. While this may at times result in short-term underperformance, we believe this approach helps to deliver on the returns the clients require within the stated timeframes.
So our funds are constructed on a bottom-up basis. Our starting point is cash, which we only allocate out of if we find opportunities with sufficiently high potential returns given the underlying risk profile. We populate portfolios from the equity, fixed income and credit buy lists constructed by investment committees in the team. In making the selection, the fund manager would consider the overall target for the fund, and they would determine how much growth assets to have overall. We take it through the cycle view and diversify across the various buy lists. As a final risk overlay, we look for and adjust for any unintended macro bets we might have on. Locally, we're finding many opportunities in good, well-run companies that are exposed to the local economy. We've been able to build positions in companies with established track records, strong management teams, and at very low prices. Top 10 holdings include examples such as Old Mutual, Supergroup, and ACI. The recent market sell-off over December has allowed the fund to build positions in new ideas such as JSE Limited. Globally, we are finding select opportunities in areas that are out of favor or neglected. More recently, we have been finding opportunities in the global brewers such as Asahi Holdings and AB InBev, as well as London-listed insurer Prudential plc.
We believe that long-term government bonds currently present one of the best risk-adjusted opportunities within our portfolios. These instruments, which offer high liquidity and a government guarantee, are currently available at high real yields. In fact, a recent study by Morgan Stanley pointed out that South African government bonds currently offer the highest real yield compared to other emerging market investment-grade peers. Other opportunities our funds are taking advantage of include Eskom government-guaranteed bonds, and South African inflation-linked bonds. Inflation-linked bonds continue to offer notable real yields and an inherent buffer against upward inflationary shocks.
Despite a period of substantial underperformance over the last 2 years, we are not finding opportunities in local listed property markets. Globally, however, fears around online retail and an overbuild of department stores are presenting opportunities in US-listed retail property companies. We have been able to find opportunities in companies listed in the US with good assets that are well run at extremely attractive margins of safety. Domestic credit instruments have generally met or exceeded our estimates of intrinsic value as yields have tightened considerably over the last year or two. They remain highly illiquid instruments and as such have a very high hurdle for inclusion. And as a result, we have been lightening them across all the funds. Our process sees our portfolios default into cash. So it's the default allocation if we can't find better opportunities elsewhere. We view cash as valuable firepower in inevitable times of market panic or volatility. In these periods, quality assets usually come on sale and it pays to be a liquidity provider.
Looking at our multi-asset portfolios, you would find that we have significant exposure to South African sensitive assets. These include the opportunity as referenced in the SA Inc. equity segment of the market and the notable opportunity within the South African fixed income market as well. Foreign equities, foreign property, and local equities listed offshore act as a counterbalance to the portfolios. In addition, the fund's allocation to inflation-linked bonds also offer additional diversification benefits, as these instruments are immune to inflationary shocks to the local economy. Finally, our cash holdings are not exposed to capital market risk. These cash holdings offer us the ability to capitalize on opportunities that could result from volatility in the equity and bond markets looking to the future.